Hello there, dividend growth stock investors. It is Colby, the DGI Crab, and in this first part of a four-part series, I'm going to go over the on-the-bubble stocks that didn't quite make it to the final list of 60 high-quality dividend growth stocks that this channel focuses on. When I went about putting together the material for this channel and this strategy, I had a stock watch list of more than 250 stocks. I kept track of all the kings, all of the aristocrats, stocks in the S&P 500 that pay a dividend, stocks that I saw covered on other channels that I thought were interesting enough to keep an eye on. And when I originally started working my way down the list and eliminating some, I had gotten to 100 high quality dividend growth stocks. And you know what? I still thought that that was too many. But I do think that there are another 40 stocks outside of the ones covered on this channel that I absolutely would not turn my nose up at you if you had them sitting in your portfolio or were excited to buy them so long as they were showing signs of undervaluation. Just like I do with the 60 growth stocks that did make the cut, I'm breaking these 40, you guessed it, down into 4 individual tiers based on age. So now we're going to jump in and take a look at the stocks that didn't quite make the cut for Tier 1, the investors aged 18 to 30. Before I do, I will say I am not a licensed financial advisor. The opinions expressed in this video are just this one crab's opinion, and you should always do your own due diligence before investing in any stock or ETF. I'll be curious to see if any of you own some of these. I'll bet you do. All right, so first one off the bench, so to speak, will be MasterCard Incorporated, stock ticker MA. MasterCard is a fantastic stock and massive company, second only to Visa in terms of the credit card companies and market cap and payment processing. Very similar to Visa, it's going to give you a low starting yield, and it's going to give you a rapid growth rate on the year-over-year dividend growth, not to mention share price appreciation. Ultimately, it didn't make the cut because, well, honestly, I just wasn't sure if I wanted to have both Visa and MasterCard in the group for the Tier 1, and I do like Visa better personally. But if I have to replace any of the stocks in the Tier 1 group, in all likelihood, MasterCard is going to be the first one up. All right, and then the next one up is Service Corporation International, stock ticker SCI. I don't see really anyone talking about this stock very much, but this is the largest funeral home and funeral services operator in the United States. Death and taxes are the only two certainties in life, right? And Service Corporation International has a major market share on one of those. They didn't make the cut because they don't have a long history of dividend increases. They've only been going here for about 10 years, but they do have numbers that I like in terms of a dividend starting yield that's typically higher than the S&P 500 and a nice 5-year growth rate at 11%. I like what they do. It's a very stable business model, and Service Corporation International was a hard one to cut. Very curious to know if any of you happen to own this one or have even heard of it, because I think it's a very interesting one to at least have on your watch list. Next is Williams-Sonoma Incorporated, stock ticker WSM. Williams-Sonoma has definitely had an excellent last couple of years for sure. They are certainly a dividend growth compounder with 17 consecutive years of growing that dividend, and their 5-year growth rate's above 16%. So definitely those are the kind of numbers that I am looking for when trying to target good investments for the people that are age 30 or younger and have plenty of time to let that 16% plus dividend growth rate compound over the long haul. Next is eBay Incorporated, stock ticker EBAY. I would certainly hope that everyone out there knows what eBay is at this point in time. Really, really tough for me to leave eBay off. They just started paying a dividend just 4 years ago. So we don't have a ton of history built up just yet for exactly what kind of dividend payer eBay is going to be. But thus far, it's been a stock that's yielded between 1 and 2% pretty consistently. And the 5-year growth rate of 30% is just fantastic. Now, I would be stunned if they could keep that up for another couple of decades. But payout ratio is nice and low at 29%. They certainly have room to continue growing that dividend and continue that streak. And with eBay, it's just a cash flow machine. I love the business model. I think it's here to stay. Next is Lincoln Electric Holdings Incorporated, stock ticker LECO. Certainly not a household name, and that kind of worked against it when putting together this list, because really with the 60 stocks that I've picked for the channel, a big part of a lot of them is that they have a certain amount of brand recognition, certain amount of market share, and the idea of them is they're sleep well at night stocks. And while Lincoln Electric Holdings has certainly put together a nice history so far, with a 9% 5-year growth rate, starting yield in the mid to high ones a lot of the time, 22 years of dividend growth. It just didn't quite live up to the numbers of the stocks that did make the cut. But Lincoln Electric is certainly an under the radar pick, and it's certainly not a bad stock to have in your portfolio. Certainly, the younger you are, the better, though. L3 Harris Technologies Incorporated, stock ticker LHS. So this is a military defense contractor. L3 Harris does a lot of things like the communications within the Army. So they do things like radios and satellites and medical vehicles. So they're not a bomb manufacturer. So if you're a young person and you feel a little weird about investing in a defense contractor that makes bombs and guns and things like that, L3 Harris might be a company that's a little bit more appealing to you. They do have a 22-year track record of growing the dividend. They've grown it a little bit slower of late. That 5-year growth rate of 6.8% is a little on the low end, but their payout ratio is low enough. I think they'll have no trouble continuing to grow that dividend. And the type of technology that they're in is certainly the kind of technology that's going to continue to be absolutely crucial for modern warfare and defense. And then we have Apple Incorporated, stock ticker AAPL. Really one of the best stocks out there to own, not going to lie. It's been an absolute machine in terms of its ability to grow and return just excellent returns to shareholders. The problem with Apple is, as a dividend growth investor, I just don't consider it a dividend growth stock in the same way that I do Microsoft. You have a very low starting yield, but the problem is you've got also a pretty slow 5-year growth rate. Apple only grows that dividend 5 to 6% a year. I don't think that the company is particularly interested in rapidly growing it, although they certainly could. Their payout ratio is very low, lots of free cash flow. If Apple would start growing that dividend 10 to 12% a year, the same way Microsoft does, then I would probably change my tune as far as that goes. But with Apple, for me personally, I have a fair amount of exposure to it through my VOO, my S&P 500 ETF, and also through VIG, my dividend appreciation ETF. It's a top 2 holding in both. So I definitely own as much Apple as I care to at this point, just through those ETFs. Again, if they start growing that yield at a faster clip than just 5%, I'll definitely be ready to change my tune. But for now, Apple is just on the outside looking in as far as that goes. So those are the on the bubble stocks for the tier 1 investors aged 18 to 30. If I ever need to replace any of the stocks that did make the final cut in my tier 1, these are the stocks that are sitting on the bench and ready to jump into the game if for whatever reason I decide it would be a good idea to make a change at some point in time down the line. All excellent stocks, certainly not bad things to have in your portfolio. And if you don't agree with my tier one and you have some other picks that you think are better options than the ones that I have available, these might be some good ones to take a look at. Again, this is not investment advice, but I've done a ton of research on dividend growth stocks, and all of these certainly had a reason to be in the final cut, and I certainly wouldn't be upset if I ever had to start a position in any of these because I needed to sell out of a position that is in that final cut. So my name is Colby, the DGI Crab. You can email me your questions at dgicrab@yahoo.com. And I hope to see you back for the next one where we go over the on the bubble stocks for tier two.